Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 1st of August. I'm Daniel Lam, your host for the podcast. There has been a confluence of macro heavyweight announcements over the last 24 hours, with the Bank of Japan raising policy rates by 15 basis points and the FOMC signaling a rate cut for September. We'll start with the Fed. The press conference continued to emphasize the need for greater confidence in the sustainability of disinflation, but Chairman Powell did acknowledge that recent data have added to that confidence. The committee's attention to the risk to both sides of its dual mandate constitute a change in language. Now, Powell acknowledged that inflation has been the Fed's main concern over the past year, but that its maximum employment mandate is coming back to the forefront. Now, he characterized the softening in the labor market as a normalization from overheated conditions. But nonetheless, he stressed that policymakers would stand ready to respond should it be more than that. The markets did cheer the clearer path of Fed pivot with strong performance in equities and sharp drop in US 10-year government bond yields, i.e. bonds positive, as well as fall in the US dollar. The macro tailwind can be a stabilizing factor for the recent pressure on the mega-cap growth stocks. Now, even more notably, the Bank of Japan engaged in a so-called double tightening move. It hiked its overnight core rate by 15 basis points to 0.25% and lowering the bond purchases to 5.3 trillion yen in August to September 2024 from 5.7 trillion yen in July 2024. The BOJ's decision not to delay the rate hike until it observed a turnaround in GDP growth in the second quarter is a very significant one. The central bank's tightening move is all the more significant, considering that economic momentum has been weak, with the first quarter GDP revised down further, and May's monthly GDP weaker than April's. So the BOJ's intention is to send a hawkish signal and defend the yen is a very significant development in our view. And the move shows that the BOJ sees yen stability and controlling inflation as more immediate concerns for Japan's growth path. So the yen continued its strength over the last 2 weeks against the US dollar. And Japan equities shrugged off the news and ended the day higher. The banks led the way, benefiting from the steepening yield curve, which helps net interest margins and profitability for the banks. We continue to like this opportunistic idea of Japan financials. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.